Hi to all. In this video, we will quickly cover how to construct a bull spread, a money spread, which is known as a bull spread, and we will construct it with call options, and then subsequently we will also use put options. Just to give you a heads up, if you construct the bull spread with put options, you face something called early exercise risk. We're not going to focus on that in this video, but I encourage you to read your book and read a little bit about this early exercise risk. But in the meantime, we're going to focus on how to construct, how to design a bull spread with call options and put options, and then how to calculate the profits from this strategy, right? So let's keep in mind a bull spread. Uh, you can design or you can construct a bull spread by buying a call. Any money spread, you're going to buy a call option and you're going to simultaneously sell a call option, and the difference between the two, those two options are going to be identical except that the strike price will be different, right? So you're going to buy a low strike, I'm going to call this low X call. So just for notation, we're going to call this strike X1, and we're going to call this call 1. And then you're going to sell or write, if we want to say it more appropriately, a high strike call, and we're going to call this call 2, right? So when we do this, what are our profits, right? So I'm going to just quickly add a page here. And if we want to calculate the profits of bull spread, then just keep in mind when you buy the call option 1, which is the call option with the low strike, you have to pay this premium, which is, we're going to call it C1, that is that premium. But because you have bought this low strike call option, now you're happy if it gets in the money, because if it gets in the money, you will have some value, which is the intrinsic value, which you can calculate as the max of the stock price minus the strike, and this strike is X1 or 0. That max of this or 0, it simply means that the intrinsic value will never be negative, because if it is negative, it's simply telling you this the option is out of the money and you would not exercise it. Now, this is your long position of that portfolio that we know as a bull spread. You also have a short position in the portfolio, which is, well, you're selling, or in other words, you're writing this call option that has a high strike price. So we're going to use that subscript 2. And because you're writing that, it means you are receiving this premium, right? So that's why it's a plus. You're receiving that premium from whoever is buying that call option from you. But then if that call option gets in the money, you will lose an amount which will be equivalent to the intrinsic value of this call option, which has a strike that is higher, so X2. Okay, so now very quickly, let's now move to Excel, where we can actually just prepare on a chart that we're going to call a profit diagram, right? So we're going to see all the possible profits given all the possible values that the stock may uh, reach, right? So for instance, we have this first price for the stock, which is 75. In other words, we are thinking, or we are assuming, that our worst case scenario is that the stock will drop to a price of 75. But you could start this at, you could start it this at 0, so there is no problem, right? You could start this at 0, then 5, then 10. But let's think about a stock that is usually trading at around 150 or 200. Then, well, you're likely not even going to be, you're probably not even concerned about the possibility of stock price going below 75. So you will start your figure, your chart at 75. And then what we do is, first, step one, get the intrinsic values of the two call options. C1 is the call option you're buying, C2 is the call option you're writing. And how do we get that? It's just max of the stock price minus the strike one. Make sure to lock this in Excel, right? Which you can do by adding these dollar signs before the letter and before the number. So you can also do it like this yourself, and you're locking it. So when we scroll this cell down, that reference to the strike will remain fixed. It will not change. It is max of stock price minus strike price or zero. And then we just scroll this down and we do the same for the second call option, which is the call option we are now writing. So it is going to be max of this stock price minus the high strike, which is X2 or zero. And once again, we need to lock this, so we can lock it by adding these dollar signs here. Remember, we can also just go to this, just place our cursor here and just press F4, and Excel will automatically add those dollar signs for you. Then you just scroll this down. Once you have that, then we will calculate the profits. So we just wrote those that formula in the whiteboard before, and the profit will be minus the premium C1, which is, well, bought you bought this call option with the low strike price. You bought it at $13.5 according to these uh, values we have in this spreadsheet, right? Now, because you bought this, make sure to lock this cell in your formula. And because you bought this, whatever the intrinsic value of that call option one is, that belongs to you. You're happy if your option gets in the money because you're getting this payoff. Now, plus you're going to add the premium of the call option 2, which is the call option that has the high strike price, because you are writing that call option that has that high strike price, and therefore you're writing it so somebody's buying it from you, so somebody's paying that premium to you. Now, after you have written that option, you have sold that option to an investor, you have received that premium. Now, if that call option gets in the money, you're not that happy because it means you will lose money, and you will lose an amount of money that is equivalent to the intrinsic value. Why are you going to lose money? Well, because even if the stock price is $1,000, you will still have to sell that stock at 15, 20, or in this case, $130, which is the strike two. Strike two is 130, right? So if the stock price goes up, skyrockets, you will have to sell at 130. So you're losing that difference between the stock price and the strike price. Then let's lock this J8, which is the cell where we have the premium of call option 2. We lock it so it doesn't change. And now we just scroll this down. We will see that bull spread, you're facing losses if stock drops, goes down, and you're facing the possibility of gains if the stock price moves up. That is a good thing. Then we need to make a final adjustment because you cannot invest in single options. So if you want to buy an option, you have to buy a contract which holds 100 options. So we just multiply this by 100. This is a very simple thing. And we will see here in this chart that this is exactly how our profits will look like for each possible value of the stock. If we want this to be more clear, we can click on select data, and this horizontal x-axis we edit it, and then we explicitly include these values, right? And then once we do that, we can see that if the stock price is 75, we're having loss. If the stock price is above this 125, then we start having gains, right? Now in the book, I'm using the same values that you can find in your book, so you can actually see how the book gets to the figure they have over there. So let me just delete all of this so we can do it again. The book is saying Well, what if instead of buying or forming a bull spread, what if you buy the call option only directly? So if you only buy the call option, this is what will happen. You will have to buy at the premium, which is C1, and we lock this. After you buy the call option, then you are entitled to get the intrinsic value, or in other words, you can exercise it or you can sell it even more for even more. And then basically this is it. The only thing is we need to multiply this by 100. We need to multiply this by 100 because we cannot invest in one single call option, but we need to buy 100 call options. And now this is it. So if you are only investing in the call option, this these are the possible profits you can attain. So let me give you a quick hint. You can, rather than editing this chart, so you can add a new line. I think it's easier just to create this new line for the option, and then we have some issue here. We have to, these 2 points should not go here, and these points should not go here. Okay, so the last stock price is this one on 175. So the chart should end there. So we create this line, a new line, only showing the call option, and then you can just copy this one. You click on the previous chart and you paste it, and then you got it. You're combining the two um, uh, charts in a single chart that has the two lines, right? So there you go. If you're investing in the call option, you have much higher losses, potential losses, if the stock drops, but you have unlimited gains. If you're forming the bull spread portfolio, then you have limited losses, you have much lower losses, but you also have lower gains, right? So this is a low risk kind of strategy. Depending on how you build it, you can make it low risk. So that is a bull spread. Now we have formed a bull spread with call options. Can we form a bull spread with put options? Yes. The only thing is we will have early exercise risk. Early exercise risk when we form it with puts. We're going to quickly mention what this is, but I encourage you to read your book. They give a good explanation. So once again, a bull spread. In a bull spread, you are buying a low strike call or put. Here is a low strike put, and you're selling a high strike put. So the same thing in the when we were building it with call options, we were buying the low strike call and selling the high strike call. Now we will buy the low strike put and sell the high strike put. So steps that we need to follow. As a matter of fact, if you look here below in this spreadsheet, you will see these three steps. First, get the intrinsic value. Second, get the profit. Third, adjust for contract size. And you have that here too. These steps are here too, and when we were working with the call options. So first, intrinsic values. In the case of put options, right, the intrinsic value is different. It's just max off the strike. Now, keep in mind, P1, that's a low strike. So in a bull spread, we are buying the low strike. But regardless, here, first thing, we need to calculate the intrinsic value. So the intrinsic value of a put option is just the strike. We lock this cell minus the stock price or 0. And there we go. And then we scroll this down. And then P2, that's the put option that has strike 2, or in other words, the put option that has the high strike. So max of strike 2, and we lock this one, minus the strike price or 0. And we scroll this down again. Okay, so you see that we're getting value from the put options when the stock price is lower, and we're not getting a value from the put options when the stock price is higher. The opposite, completely the opposite to what we were seeing when we were forming the bull spread, right? When we were forming the bull spread with call options. This is still a bull spread, but now with put options. Now, what about the profits? So let's keep in mind you were buying the low strike put. So you have to pay minus negative the premium of the low strike put. Okay, and we lock this. And because you bought the low strike put P1, you paid this premium of $11.5. Now you are entitled, or you're likely gaining from the intrinsic value of this put option, which we have here. At the same time, keep in mind the whole portfolio is formed because you also have a short side, a short component, which is you are writing or selling the put option 2, which is the put option with the high strike price. Let's lock this sell. And because you wrote this put option, you're getting the premium. You're getting that money's coming to your pockets. And because you already received that premium, now if that put option gets in the money, then that buyer, that investor will want to exercise it, then and you will lose the intrinsic value. So we subtract the intrinsic value from P from this put option 2 or P2. Now we scroll this down, and it's not surprising that we again this is a bull spread. So whenever you are forming a bull spread, even in this case when you're forming the bull spread with put options, you are betting on the stock moving up. So you're going to make money if the stock moves up. And you're going to lose money if the stock moves down. So we can see this here. Now we just make the adjustment for contract size, which is just multiplying by 100 because you cannot buy a single put option. And we see this nice figure here. Now let's also compare, okay, what happens if we had only invested in the put option with the strike 130, right, with the high strike. So if we had only invested in that put option, then we would have paid that premium. We locked this sell. And because we paid that premium, we would have been entitled to the intrinsic value of this option. Finally, we multiply this by 100. And that's it. And we can scroll this down. And in this case, it was already set up in the chart. So we already get it right there. Now, this chart now has the two possibilities. What if you are investing in a put option, or if you're forming a bull spread with put options, right? And we see it's completely opposite because given that this is a bull spread, even though you're building it with put options, you are gaining money in the strategy, the orange line, you're gaining money when the stock moves up, which is completely the opposite to what happens with each of the put options you have, which in which you're likely you're used to get money when the stock price moves down, right? So for the put option that still holds, but your portfolio is a bull spread, so you're still in the bull spread, you're gaining money if the stock moves up, and you're losing money if the stock price moves down. Okay, so this is bull spreads, and we have built it with call options and with put options. In the next video, we are going to work and we're going to construct a bear spread. Okay, thank you.